This is Smart Investing with Mike Rand.
That is so cool.
Counterpoint, no, it's not.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Rand.
And as long as my mom thinks I have a job here, I'm good to go.
With Michael's producer, Chris Martin.
I'm ashamed God made me a man.
I don't think God's doing a lot of bragging about it either.
This show is live.
And call-ins are welcome.
And call-ins are welcome. Or you can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Rand.
Hello, everybody. We're back with Smart Investing. I am Mike Wren, your host. Telephone number here to the studio is 509-241-5900. You can find us on the web at smartinvestingshow.com, and you're listening live at 590 KQNT AM. So the first hour, I was telling you a lot of the start of why most people are bound to get it wrong for very, very good reasons that are not your fault. Then I told you several things that you shouldn't even do. And then I told you a few things at the end of the hour that you should do. Okay? If you need more advice, or if you have a question what you should or shouldn't do, call 509-241-5900. So another thing that you should do is when you're thinking about investing, you are looking at companies. Okay? At least I'm looking at companies. And almost nobody looks at companies anymore because, frankly, I get the feeling that the whole world doesn't take investing as seriously as they should. It's so accessible now via the internet or via packaged products like mutual funds and annuities and exchange-traded funds that the pomp and circumstance is gone away. And that's completely a bad thing because the pomp and circumstance is exactly that. It's kind of like spring training for baseball. Catch the ball, throw the ball, hit the ball. That's it. Okay? And being in shape. My industry and you as an investor need that spring sort of training. You need to know what an income sheet is and an income statement and a balance sheet and things like that. You need to know about what the growth rate of earnings for that company has been normalized over like the last decade. You would want to know that if you were buying a 7-Eleven. You'd want to know how much sales per month that 7-Eleven is doing. What are the good months? What are the bad months? When you might need more help? How much this costs, how much that costs, what the taxes of the business are. See all those details?
Yep.
If you think about the details, you don't have time for somebody to sell you a piece of junk. You don't have time to scour the internet for something that agrees with your beliefs. You don't have time to watch CNBC. You're too busy doing real work, real investigation. My industry, when they have all these pre-printed brochures and they love these mutual funds and these annuities, and then they say, well, one is kind of, well, crap, what am I going to talk about? I better talk about 10 funds, so there's plenty of them to talk about, so I appear sophisticated and that it's complicated, and so you actually think that you're getting something for your money.
Well, and seriously, though, I know that impresses a lot of people because they're walking out of there with something.
Yeah.
I went in and talked to him. He gave me this binder to look through, like anybody really looks through the binder.
And I'm thinking people that come out of my office look a little bit shell-shocked, dazed, and shaking their heads. And shaking their heads.
All Mike gave me was a headache. And I had that all the way to the car. This binder I still have.
I felt okay when we went in, and I feel much worse now that we've come out.
I feel like a roller coaster ride after that. The other guy was all pump, and I couldn't understand a word he was saying, but I left with this binder and these cassettes.
Yeah, truly. I don't think there's near enough talk. All the talk is about something called risk, what your risk tolerance is. And it is so hard for me right now not to use cuss words because truly it's right on, all these words are right on the tip of my tongue because it's all the letters BS, and that's the most gentle of words, okay?
Horse hockey.
Yeah.
I've been watching MASH.
Yeah. The risk is doing the wrong thing. To me, that's your risk tolerance. Okay. Well, maybe we should have you a little bit. Their theory is, okay, risk tolerance. We're going to have you in so many bonds and so much in bonds and so much in stock. Okay. That's, asset allocation. Blah, 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 blah. And by the way, my arm hair is so thick it covers my wristwatch. I mean, that's...
No, I'm not wearing a sweater, but thank you for asking.
Just random stuff enters my head because what they start talking about is so meaningless. So
everybody's had that guy where he's talking to, and then you start looking. Is his one eye lower than the other? I wonder did I turn the stove off?
Is the iron on?
We've all been there.
When's my wife's birthday again?
I do that while my wife's telling me when her birthday is. I wonder if she's telling me when her birthday is.
Yeah, so they're sitting there telling you, well, you should own this many bonds of stock, and I'm the one telling you, well, in a different market environment, I don't mind owning a few other things other than stocks because I'm not worried about getting my head handed to me in those investments. But you have to realize that we're only using those investments to try to get something other than the best performance because we're not going to get the best performance from those other investments. We're using them for something else that you might need, like a current level of income above and beyond your need for growth, something like that. But in this day and age, when you have the interest rates on the debt of a corporation paying you the same as you get to own the common stock, to me, it's a no-brainer. When's the last time the government ever called you up and said, oh, we're raising your interest rate on your bond that you currently own? Never. When's the last time a bank has called you up and say, we're feeling extra generous. Interest rates went up. We're going to raise your rate on a CD even before before it matures. We're not going to make you wait. We're going to give it to you now. Never going to happen. Never. Gosh, this guy really doesn't like banks, does he?
This guy really doesn't like anybody that wears a suit.
He doesn't like anybody.
My mic cut out. I was gonna defend you, and my mic cut out.
So yeah, my industry, they're talking about their mouth is moving, but nothing's coming out that makes any sense to me as an investor. Why on earth would I want to diversify you? And the places that I was diversifying into, I'm pretty 95% sure you're going to get killed. Well, because it looks pretty. You see how I have these mutual funds are color-coded purple and these are red, and when you put them together, it looks wonderful.
This pie chart cost us $100,000.
Yeah. The way I invest, look at a Pablo Picasso profile. Then you know how I think.
Yeah. So you got like the whole Dr. Phil thing going.
No.
You know how you invest? Well, investing's like having a bunch of cockroaches in some tin foil.
To me, investing is logic and art, and I can prove it to you. When's the last time that you've ran into an engineer or an accountant that has a complete grasp of their discipline and mathematics, and they're also a wonderful investor? I rest my case. It's not just about the math. And when is the last time that you saw somebody smoking something that said that they were an artist that is a perfect investor? You need both.
Can I go one nerdier?
Well, no, let me just say, I'm one of the rare people that gives you both. You have to have a sense of art to be able to follow your nose and find the good investment. Now it's your turn.
Well, I was going to say, we've talked about the whole Kirk and Spock thing.
Yeah.
And, would you want to hang out with Spock? No. But would you want Kirk doing your taxes?
Right.
No. You need a little bit of both.
Would you want Spock getting you the best price on Priceline?
Would you want Spock to be your wingman?
Gosh, thankfully it's time for a break. That guy hates everybody. So
wait, Kirk and Spock don't wear suits. I'm starting to see a run here.
They wear tights. That's even worse. So
Oh, yeah, it's break time.
I'm Mike Wren. It's the show Smart Investing. I'd love a phone call if you wanted to talk about something. It's 509-241-5900. You can find us on the web at smartinvestingshow.com, and we'll be right back.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
What is this, a green card thing?
No.
Closet case?
I don't think so.
This is Smart Investing with Michael J. Wren.
Bundy-esque serial killer?
That was my first thought, but no.
Hello, everybody. We're back with Smart Investing. I'm Mike Wren, your host. So, yes, I think that my industry doesn't take investing too seriously enough, and it's a serious thing. It's I think that ease of access to the investment industry isn't necessarily a good thing because you can lose money. It's kind of like you going into ER and them saying, well, yeah, you can see a doctor, but if you want to try to do things straight away right now, there's a cabinet with some drugs in it.
There's a table with some scalpels. Just wash them off when you're done.
Yeah.
So basically, you're not saying. See, I kind of thought you were saying the ease of investing is more people can use the internet and find out a bunch of stuff. You're saying it's stuff like E-Trade or something that you can just log on and boom, I'm a trader.
Yeah. Well, and the fact that you can go to all my competitors, they're just going to talk about packaged products with you. They're not going to talk about investing in individual companies or, for that matter, individual bonds. Well, what the hell do you think is in a mutual fund? Stocks and bonds. Well, shouldn't you know a little bit about them? Nah. I got the manager to do that.
Well, my friend's really successful at it, and he doesn't know anything.
Yeah, well, let's just follow this through. The manager's doing that, or the group of managers. Okay, then what are their names, smart person? Well, they either will tell you or they don't. Now, do you know them? Well, no. Do you know of them? Do you follow them closely? Yeah, I follow some funds very closely. I know what the fund is buying. I know what they're getting rid of. Albeit it's 3 to 6 months later, but that's okay because the fund is dealing in huge positions. It takes them months to buy as much of a company as they wish, or it takes them months to get rid of a company that they want to get rid of. Do you see what I'm saying? Is that there should be some education going on, and it should be kind of a laborious process to invest. It becomes less laborious after you know the professional that you work with, and to be frank, after you've made some money, after you've had some good experiences. If you don't have a good relationship with this person and you don't have good experiences and not making any money, it's always going to be laborious, or it should always be. You know what I mean? Yeah. It's like let's skip all of the training. Let's just run the bloody marathon. I've got some people that'll run right next to you and shove a needle in your rear end. You know what? I don't know. It's just that they have the appearance that investing in these packaged products makes everything easier, and it doesn't make it even 1% easier. And I mean easier emotionally and from your behavior. Okay, so what's this email? Let's bring that up. I think I remember, but I'll let you talk for a second.
Okay. Hello, Michael.
Hi.
This is not necessarily his voice. I appreciate your show. Let me emphasize that. He appreciates the show.
Well, I wish he would call because we haven't had any callers at all this show. Oh, okay.
He wrote.
Okay.
So this way I know if they write. This way I know at least if they're going to curse or not. So I'm all set. I'm not panicky reading emails. I was not able to hear the entire 1 o'clock hour of the Saturday show. Specifically, I was hoping to hear your recommendations for alternatives to bonds. Is the show podcast? Well, yes, it is. Go to smartinvestingshow.com and hit podcast, and you can download those. I hear you and others talking about how this may be a good time to get out of bonds. My wife and I are both 45 and have about 80% in highly diversified equity mutual funds and 20% in bonds in our retirement funds. We would love to hear what you feel would be good alternatives to bonds over the next several years.
What's his name?
Thanks, John.
John, thanks for writing the email. I appreciate you listening to the show as well. In this day and age, just about everything is an alternative. If I'm worried about you losing money in bonds, then the first alternative to owning bonds is having it in the darn bank. Well, Mike, I'm not going to get as much interest in the bond. Well, okay, great. Let's say the bond is paying you 4, 5, or 6% interest, and it goes down by 10%. So you're a negative, what, 4? I rest my case. So the first bond alternative would be nothing, would be cash. Not in your mattress, because Chris might find it. So I would put it in the bank. The second alternative, well, the bank's not paying me nothing. I would like to make something. Okay?
Sound a little like Cameron from Ferris Bueller when he was doing his dad there.
Yeah, I can do that, by the way. Hello, everybody. So the next alternative is, one of the alternatives is that it's a banking product. The mutual fund industry offers it. And it's one of those things that we have to go to a package product to get it because it would be called senior collateralized debt obligations. How's that? Doesn't that just roll off the tongue? What is it? Mike, what the hell's that? Okay, well, what a senior collateralized debt obligation is it's a loan that a smaller type company would take from a bank. And this loan is kind of like a credit card loan where the interest rate that the company pays the bank fluctuates based on the interest rates of the world. The one big risk that you have with owning a fixed income investment like a bond is that your interest rate is fixed. And if interest rates go up between the time that you buy your bond and between the time it matures, you're kind of screwed. You are going to lose principal if you want out of that bond early. And you're also forced to hold on to this bond that might be paying you a lower rate of interest than is currently available from a new bond. A senior collateralized debt obligation has a floating rate, usually based on LIBOR. And what you can do is at London Interbank something, it's a worldwide kind of interest rate instead of just an interest rate based in here. Instead of the federal rate prime rate, this would be like the world prime rate. That's what LIBOR is.
I'll take your word for it.
Okay. So this type of an investment will fluctuate with the interest rate that's on LIBOR up and down. So if interest rates are really, really low and expected to go upward, if you invest in these senior collateralized debt obligations through a package product like a mutual fund, then the interest rate that one of this type of a package product of an investment will pay will reset upward as interest rates tend to go up. And if they reset downward, they'll reset down too. Now, when we're sitting at interest rates so excruciatingly low right now, I think that the risks to owning one of those, as far as interest rate risk, is probably pretty minimal. I would think that interest rates are tending to go up, and you're protected that way. Well, then why wouldn't everybody do it? Because there's another risk. Chris, you've been to the mall with your kids.
I have.
The malls over the last 2 or 3 years, there's been some walled off areas to the walls where there was a store before and now there's not. Have you noticed that?
I call that the University City Syndrome.
Okay.
And I just aged myself if anybody recognizes the U City.
Yeah,
but yes, there used to be, you're walking by and, well, that's funny. They used to be there yesterday and
okay.
Now there's walls.
That's the problem with the Senior Collateralized Debt Obligation Fund, is that the types of companies that aren't big enough to float their own bond issue and they still need cash, there's risk to them. So there's default risk to those Senior Collateralized Debt Funds. So it's not a free lunch. And, of course, the alternative to bonds right now that is an amazing thing are stocks. Because of the dividend yields on stocks that are being paid right now, they are equal to or greater than typically the interest rates that you get from bonds. But the bonds never increase the interest rate unless you have a senior collateralized debt fund, and then you're dealing with smaller companies that are in sometimes tenuous cash positions. When you're dealing with companies that have the opposite of a tenuous cash position, they've got more money than God, and they're paying out a dividend consistently, and they probably have raised the dividend every year for 20, 30 years. That sounds kind of okay. A dividend increase every year for 10, 20, 30 years, you say? They've been paying dividends longer than I've been alive or been married. Yeah, that's pretty much what I'm telling you. That's what I think is the mother of all bond alternatives. That's your answer. And we'll take a break. I'm Mike Wren. It's the show Smart Investing. You're listening live on 590 KQNT AM. The telephone number here to the studio is 509-241-5900. When we come back, I'll give you some more things to look at when you are evaluating investments.
This is Smart Investing with Michael J. Wren and Michael's co-host, Chris Martin.
You've dedicated your life's work to educating the general populace. Have you ever considered trying to do something useful?
We're trying that now.
Exactly. Hey, we're back. I'm Mike Wren. It's the show Smart Investing. You're listening live on 590 KQNT AM. Telephone number here to the studio, 509-241-5900. You can find us on the web at smartinvestingshow.com. If you want to care to call to my office, you can find me on the internet. It's spelled W-R-E-N, my last name, so it's Wren Investment Management. This is our longest segment of the final hour, so this is a good segment. If you do wish to call for a question or a comment, make it this segment, not the last one. The last one kind of gets pressed for time.
We had one last week, and I hate to cut people off like that.
Yeah, I hate to give them the bum's rush. I'm willing to, just don't like doing it. So,
because I'm not sticking around afterwards. Work is over.
Not even for 40 seconds. It's our Saturday,
I don't know you that well.
So what do I look at when I'm looking at investments? Or what should I look at, Mike, after you've spent an hour and a half berating us of what not to do? Okay. Here's what you do. Most of the time, you work some other job and career other than picking investments. So that's why it probably would be nice if you had help. And it's also why the index funds, they are an alternative. If somebody says, well, I just want to start out with index funds and I don't want to use any professional investor, I can see that. There's nothing wrong with that in the beginning. Like I said, in the beginning, I don't think there's anything wrong with that at all. You're not going to get pushback from me. It's just if you're using index funds, make sure you're not having to pay for them. Make sure you're not getting professional advice with them. You don't need professional advice. You might need a psychoanalyst to make sure that you don't panic out of them. But yeah, you don't need a professional helping you. I'm not going to waste my time helping you because there's nothing to do. But other than that, if we're actually going to be picking investments, Chris, how do you determine, if you're going to buy a house, how do you determine if the price is too high or low?
By what I make.
Exactly. That's number one. Yeah. So how does somebody go about shopping for a house? How do you try to make sure that you're not paying too much for a house?
Oh, I don't unless I start asking around, and then I'll figure.
Hold on. Asking around. What do you mean?
Well, asking the real estate person, and
what do they provide?
Like information
about
the house,
and just that one house.
Well, other houses, yeah. I'll go, hey, I have this much money, and then after they get done laughing, they'll show me some papers that they have to dust off underneath the cabinet, and they'll go, well, you can afford these. You get the smell of meth out, and then I'll look through those houses and determine whether I want to buy them or not.
What would those other houses be called?
Property?
Yeah, but comparisons, right? You're going to compare?
Oh, yeah.
Okay. That's what I was trying to get at.
All right.
Sorry, listeners, that it took me a long time to get Chris to that point, but he's kind of difficult sometimes.
Felt like my
when he's not wearing the shock collar. So,
what do you want me to say, Mike?
So when you're looking at buying a house, you compare it to other similar properties in a similar location to try to hopefully get an idea of what it's worth.
Right.
Perfect. That's what you want to do with some companies. So my first advice is when I'm trying to look at maybe what an oil company is worth, I don't compare it to a drug company. And I don't compare a drug company, at least at first, to a computer company. And I don't compare a computer company to Coca-Cola. And I don't compare Coca-Cola to an insurance company. Okay?
Well, that just seems to me like I would be comparing the house I'm going to buy to a building. What would be cheaper to sleep in?
You're right. But my competitors do this. So I need to start here. So when I'm comparing a telecommunications company, I look to see what its competitors are worth, what they're trading at, okay, to give an idea. But it's not the stock price. So here's some categories: telecommunications, defense, drugs and biotechnology, packaging, chemicals, computer, financials, food and tobacco, actually, power utilities, and I'm just reading from my own cheat sheet. I have a big list of cyclicals, and we can talk about that.
I hope we can.
Well, cyclicals. Let me talk. I'm not going to dive into that on this show unless somebody calls. Just if you don't know what a cyclical is, great, no problem. We don't have to talk about it then. So
that thing you swing in your garden, right?
Right.
Okay.
Yeah. The Grim Reaper has one.
Yes.
Okay.
He's got a lot of cyclicals.
So yeah, it helps.
Texas.
It helps to look at a category that whatever company that I think that I want to invest in, I look at the category. And what am I looking at? Well, firstly, I'll see which are, truly, this is how I do it, which are the biggest companies and which are the smallest companies. So we're talking total price. But you might be thinking price per share. No, I mean the market capitalization. What's the whole company worth? If we were going to buy the whole company, how many millions or billions is it? Okay, and to give you an idea, I think most people are familiar with Coca-Cola and most people are familiar with Pepsi. Pepsi trades at $112 billion and Coca-Cola trades at $173 billion. So there's quite a bit of a difference.
Now I understand why they have all those advertisings for Pepsi. They're just really falling behind.
Well, that tells me that if I had a couple $100 billion to spend, if I bought Coke, I'd have $25 billion left over. And if I bought Pepsi, I'd have $90 billion left over. So, I'd have some money. Truly, youth have to think like that.
That'd be good if I spent that much. I'd want a little extra.
Okay, so that's our first comparison. The second comparison is okay, that's what they're worth. What is that price in relation to their assets, their property and their plant and their equipment, the tangible stuff in this company?
The logos.
Yeah, and one intangible in there called book value that we can get into again if we wish. But oddly enough, these companies trade at exactly the same, unless I inputted them wrong, I could probably check it, but they're going, let's say not exactly the same, but close to the same, for 5 times book value. So that means for every dollar of assets that they show on their balance sheet, we would have to pay $5. That's a pretty big premium. So if they said this is all of our trucks and our plant and our equipment and our cash and bank accounts, chairs, computers, desks, blah, 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 this is what it's worth times 5. That's what you can buy the company for.
We have 100 things at $1 a piece. Yeah. You can buy it for $500.
Why would they be able to charge so much of a premium? Well, think of the brand name. Think of the going concern of the business that they have. They've got a lot of business happening every day. They sell lots of different things. It's a really going concern. But based on assets, based on the assets that they have, they're pretty much at a virtual dead heat. Let's look at, as a bond replacement, how much income would we get from these companies? Income, not waiting for the stock price to go up or go down. Just if we put our money into these companies, how much money would we get back yearly? From Pepsi, right now, we would get 3% on our money back in dividends. On Coke, we'd get 2.6. So 3%, try to find a 3% CD out there. You can't. So 3% and a 2.6, you can't find that on a CD either. Those two rates meet or exceed the 30-year Treasury bond. They're way, way higher than the 10-year Treasury bond. They are equal to a lot of corporate bonds. They're way, way better than the bank. then they actually increase their dividends typically on a yearly basis. So just the interest rate that I'm going to get by owning the entire company or owning shares of the company, it's better than I can get most places. Okay? You follow me so far? Then we think, okay, so what are their earnings? What kind? Finally, I go back to earnings where everybody might, well, Mike, when are you going to get to that? Or maybe not. This says, what are they earning? Okay. I look at forward-looking earnings, which means looking to the future instead of the past. I look at the past as well. But right now, Pepsi is looking to earn about $4 a share, Coca-Cola, $2 a share. That means that Pepsi, for the whole price of Pepsi, it's trading at what? Now, this is going to get confusing to somebody. Its PE ratio is 18 or thereabouts. So it's trading at 18 times its earnings. And Coca-Cola is trading at 19 times its earnings. That seems kind of high, okay? You're right. What you try to get is this price-earnings ratio that you get by dividing the earnings into the price, okay? You come up with this ratio. What this ratio tells us is how pricey the earnings stream of customers' revenues and the earnings that are expected to come in from the company, how pricey that is. We are paying up for the earnings. Like they're saying basically, look, we've got a business that generates all this money. You just buying it and doing nothing, you're going to be making some profits. So we're going to charge you a lot. Okay? So what you typically want to do is have this price earnings number, this ratio number, equal the rate of growth of the earnings. So what you would hope is if Pepsi was trading at 18 times earnings, you would hope that their earnings are going up at a clip of 18% per year. That's not the case. They're only growing at 8. So there's a very significant with premium to that company. People right now are willing to pay a lot for that earnings stream of Pepsi because they think it's solid and with the high dividends. So it's trading. It's not the cheapest out there, but again, what else are you going to do?
Well, it's for a long-term thing. We've always discussed that. You're not buying Pepsi to turn it around and make a profit.
Exactly, but how about if we could buy a company where that price-earnings ratio was actually less than the earnings growth rate, where we weren't having to pay a premium for the earnings? Mm-hmm. That would be even better, wouldn't it?
Yes.
When we come back from the break, I'll show you an example for that. I'm Mike Wren. It's the show Smart Investing. You're listening live at at 590 KQNT AM. Telephone number here to the studio. Do you have a question, comment, want to talk? 509-241-5900. We'll be right back.
This is Smart Investing with Michael J. Wren.
Your thoughts, Tracy Jordan, on how this is going to impact Wall Street?
Larry, I'm not an expert, but I do have a strong opinion.
Hello, everybody. We're back with Smart Investing. I'm Mike Wren, your host. Telephone number here to the studio is 509-241-5900. So what we're kind of talking about, it's a little bit esoteric for the radio, but we're talking about when we're buying a company, we're wondering how big the company is, how much the entire company costs, if we're going to get any sort of income from the company in terms of dividends, the sharing of profits. Of course, I'd like to look at debt out there, too. I want to see if the company has any debt. Sometimes a company's completely debt-free, like an Intel or a Texas Instruments. Okay? There's just a lot of different schematics, and I'm trying to keep the most interesting ones, the ones that are easy to explain or the easy to talk about. So we don't want to buy a company that has too much debt. It's nice if the company has a lot of cash. Yeah, perfect. If they create a lot of cash through earnings, that's even better. Now, Coca-Cola and Pepsi, they trade for almost double their earnings rate. So if their earnings are going up by 8 or 9% per year, they're trading at like 16 to 18 times those earnings. So we're having to pay up for future earnings. Their earnings are so consistent that people are willing to pay a premium for them because they're very much expected to grow their earnings at that rate. Typically, if a company is growing their earnings, if they're increasing their profits by, say, 10% per year, you'd like to be able to pay about 10 on a PE ratio when you buy the company. Sometimes you can get and it's very, very hard to get a good deal that way. I'm looking through the list right now. It's only the 1st of February, the first week of February, so there's a lot of earnings expectations and earnings estimates that haven't been released yet for 2013 that I follow. So a lot of the numbers on my cheat sheet are a little bit skewed. But one right now, this is a favorite company for a lot of people to hate that I don't hate at all. Bank America. Okay? Bank America right now, if you look at the average analysts, and the analysts are always wrong, so I take it with a grain of salt, but the average analyst out there on Wall Street expects Bank America's earnings to increase by 26% from this year to next year. That's pretty good. So by all rights, Bank America might have an earnings ratio, a PE ratio of 20 or 26 to equal that. No, it's nowhere near. Bank America has a price-earnings ratio of about 10. So here, the PE ratio, price earnings, is only about half of maybe for this one particular year. We haven't normalized these earnings or the earnings expectations or the PE. We're just looking at this one snapshot in time. It's like, wow, that's interesting. So something is askew here. Either the analysts are completely off their mark, thinking that their earnings are going to go up by way too huge an amount, or nobody's willing to pay very high of a price for Bank America because they're kind of pissed off at them. I wonder which one's more the case. Bank America, mortgages, kicking people out of their house that didn't need to be kicked out. It might be the latter.
You think?
You think? Yeah. So there might be a bad taste in somebody's mouth about Bank America where they, earnings schmurnings, I don't want to own them at all. Well, I do. Looks like a very, very good deal to me based on earnings. Now, this is cold, hard calculation. Cigarettes. Most people don't like cigarettes out there.
I was just going to say, you get people that you don't, I don't want to invest in those cigarettes. Make a lot of money. Sorry about that.
Well, yeah, and here's the thing. We've got Altria, which is domestic Philip Morris, and then we have Philip Morris International, and their price-earnings ratios are stuck at 14 and 15, respectively, so you would expect that their earnings would be growing by 14 and 15%, or at least you'd hope. Now, the other food group, the rest of the food group, it looks like their earnings, most of the Wall Street is expecting them to grow at about 6 to 8%. The reason I'm looking elsewhere is because I don't think the numbers have changed because there's no growth rate for Altria and Philip Morris. In other words, the numbers aren't different enough to even equal a 1% growth in profits. That number one, there's going to be a mistake there. I bet you some new estimates will be released. Number two, obviously, Wall Street, or the market, if you will, most buyers of those stocks are the analysts are looking at them thinking that the earnings aren't going to increase very much. The analysts are always wrong, one way or the other. If we take a look at a Boeing, we've heard about the Boeing news and batteries and so on. The analysts right now, as it sits, they actually have Boeing making less money next year than this year.
But that's impossible.
No,
I've seen the stuff on the news. They're all their planes are crashing or burning.
Well, no,
or something.
That's what people mean. Is if their earnings went down, I don't think they would. But at this date and time, with the analyst estimates and so on, you see how you've got to realize that it's an auction type of a market, like Pike Street. People get in bad moods about a company, like an Apple, drive down the price. People get in good moods about a company, drive the price up too much. See, we're talking about do you see how a lot of this is wishy-washy?
Yeah.
Yeah, you've got to find your way through the wishy-washy types of figures out there. And there are many, many other figures. What I wanted to try to get to you is that the good companies that we would be buying have a growth rate of their earnings. We don't want to have to pay too much for that growth rate. If we have to pay too much, let's move on and look at a different company where we might be able to get a good deal. And it's very, very instructive to look at the companies, sorry about that, to look at companies that are in similar industries firstly. And then if we don't have enough money to own all the industries that we wish to own, we've got to pick and choose. That's where I come in. It's like taking the view of big overview of our economy. Do I think that owning a defense company is going to be just as profitable as owning a drug manufacturer. Kind of depends on the environment. The environment.
The environment and your how you feel.
Yeah, but the environment right now truly is that there are a lot of tax cuts. There's a lot of people thinking that we need to have less equipment in the military. So defense contractors that build tanks and airplanes, I would think that it's a little bit harder for them than usual to make money. I don't think that you have that same sort of downward pressure when it comes to selling drugs to an older population.
Or to anybody, if you've watched the news lately. So,
well, yeah, and that's why last week when I told or the week before, one of the things I said, here's are a couple of news items, here's a couple tidbits that people aren't ready for. You're basically not ready for good news. You're not ready for Congress and politicians to come to an agreement more quickly than they have been. I didn't say a good agreement. I just said an agreement. You're not ready for automotive demand for new cars to be higher than it has been over the last 5 years, but it is higher. You're not ready for unemployment to go down a little bit because of all the hiring and money being spent on infrastructure in the oil fields in the middle of the United States having to deal with natural gas and oil pipelines. You're not ready for housing to actually recover enough that that affects unemployment there too. So basically, the average investor out there isn't ready for more good news rather than bad news. Everybody's kind of conditioned to bad news. And that's how you can take where you're taking you have to take a step back and look at the economy, and you just have to think, is there anything that's either definitely good or definitely negative about this industry at this date and time?
Right.
That helps, and anybody can do that. Also, one of the things that you can do, you can look at the mall.
But I don't know anybody can do it because we talked about the previous hour. There's some people that have that emotion that they've got to step aside, then look at it.
I guess the thing that I'd like to leave this show with now is, do you see how much different than is that this kind of speaking is and this kind of talking and discussion than looking at packaged products all the time? See, the packaged products are being sold to you typically without thought and without any investment process. I think that if you're going to invest in a packaged product, you should take the same amount of time and the same amount of due diligence and investigation as if you were buying a corner grocery store. I'm Mike Wren. It's the show Smart Investing. You've been listening to 590 KQNT AM. If you'd like to contact me during normal business hours, you can go ahead and call me at my office of Wren Investment Management. That number's 888-747-5181. Have a very good weekend.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.